Okay, we are now live. If everyone could mute your phones. Bob, take it away.
Yeah, thank you for rejoining the meeting. And at this time, I'd like to call the Pension Committee meeting to order. And I would also like to turn the meeting over to Brian Schultz.
Thanks, Bob. Jim and Tim, everyone got the presentation in advance. So if you'd like to go ahead and start, that'd be great.
We'd be happy to, Brian. The first question we have for you, though, is how much time do you have allotted for us this morning?
30 minutes.
30?
Yes.
Okay, terrific. So we'll start. Tim is going to take you through the investment results with a brief update through just a day or two ago. And then I will get into our capital markets review, and we will very comfortably be able to wrap up by 10 o'clock.
All right, thank you, Jim. Good morning again, everyone. I just would like to start with the actual portfolio presentation. We sent you 2 reports, so this would be the first one that just is titled Central New York Centro, and we'll start with the asset allocation of the defined benefit plan. I'll go through this very quickly just to cover the overall asset allocation and to remind you that at the beginning of April we did have approval from the pension committee to increase the equity allocation. So this is looking back at the end of the quarter, right before that increase was enacted. So the equity was at 52%. Fixed income at 43%, and we have in the middle of March raised a little bit of extra cash to shorten the duration of the bond portfolio and make sure there was adequate liquidity, and that is just under 5%. Page 2, looking at the...
I got it.
Yeah, sorry about that, I'm getting a little bit of feedback. Page 2, looking at the equity allocation of the non-salaried DB plan. Equity was represented roughly 25, almost 26% international. The rest domestic equities. The largest holding, 54%, the S&P 500 large cap, which in the market downturn that we've recently experienced did hold up the best from a decline at just under 54% exposure. The rest spread down the market capitalization spectrum between large value, mid, and small and micro cap stocks. We also had a position in fixed income, which for the portfolio performance was obviously quite helpful in the market downturn, providing positive returns to dampen some of the negative returns that we saw from the equity market. Most of that exposure is in the broad bond market, the total bond market funds, which are representative of both treasuries, agencies, and corporate bonds, and then just a little bit in investment grade corporates, and then short-term government treasuries to, again, shorten the duration just slightly in the bond portfolio.
Tim?
Looking at yes?
Getting back to the equity section, am I reading this correctly that about 26% of the 52% of equities is in international?
It's 25%, so that's a 25% of 100% of the equities.
Okay.
And 52%, so that's only looking at the equity exposure, so that's a percentage of the equity portfolio.
Okay.
So
25% of the equities are international.
Correct.
Yeah, you would have of the total portfolio, roughly 12.5% to 13% of the total portfolio is invested in international equities.
Okay, thank you.
And then just to cover the performance, looking again, this is since the end of the quarter, and this is up to the end of the quarter, and we've had a fairly significant recovery post that, which we'll update you on the new slide. But we're looking at a decline of about 12% for the overall non-salaried plan as of the end of March. Value at $27.9 million and a loss of about $3.9 million. If we go to the next page, you can see the allocation in terms of how that performance was broken out. Equities declined just shy of 24%. And again, as I mentioned, the S&P 500 up down about 19%, but the other asset classes down a little bit more than that. But the fixed income providing some support here, up about 2%, to get you that decline of about 12% during the quarter.
Just as a reminder, if everyone could mute your phones.
Thank you. The next two pages, just given the amount of time we have, I won't cover those, but those are the holdings, portfolio holdings for the non-salary plan and the exposure. So they'll show you, just to illustrate that question about how much is in the international allocation, would be on those pages. Quickly, just to cover the Centro salaried DB plan, allocation for all three plans managed exactly the same. You can see the equity allocation at the end of March at 52%, fixed income at 43%, and just shy of 5% for cash. And again, just to highlight, that cash was raised from the fixed income portfolio, not from equities. And that was primarily as a way to make sure there was liquidity if the markets were potentially closed down in March, as well as to, as I mentioned, shorten the duration of the bond portfolio. Similar story if we move to page 9 for equities, 25.8% in international, again, just as a percentage of the equity portfolio, the rest on domestic holdings. Fixed income allocated the same way, roughly 90% in the broad bond market, a few holdings to shorten the duration in corporate investment grade and short-term U.S. government bonds. Salary plan performed in similar way to the non-salary, decline of about 12% for the 3 months of the quarter, loss of $2.7 million, value of $26.8 million at the end of the quarter. You see the equity holdings performed similarly, down about 24%, 2% gain in bonds, so that brings together that total portfolio decline of about 12%. Portfolio holdings on 13 and 14. 15 is the update on the Utica DB plan. Again, similar allocation, roughly 50-50, 52% equity, 42% fixed income, and a little bit over 5% cash. That was, again, part of the fixed income portfolio is how we look at the allocation there. Page 16, at 27.4% international, broken off in the bar chart on the right-hand side of the page, and then the remainder in domestic equities. Similar allocation to the holdings, 52% in the S&P 500 large cap holdings. And fixed income, same page, page 17, similar allocation, 90% to the broad bond market. Page 19, the performance of the Utica DB plan, equities down just shy of 24%. Similar holdings, you can see 2% return for fixed income, and for the overall decline of negative 12.48%. Any questions at all about that before I move over to the update of performance?
Yes, it's Bob Suslich. When you're referring to the broad bond market, is that including lower rated corporate bonds, i.e. non-bank quality paper?
It is, what we're referring to is the broad bond market is the Vanguard Total Bond Market Index Fund. So those are the holdings that are in the broad bond market representative of the Barclays aggregate. So, so there is some below investment grade bonds in that portfolio.
Excuse me, I just want to make clear, it is a very small amount of the of that holding would be non-investment grade. Almost every, the average credit quality, the weighted average credit quality is high AA.
Okay, however, the percent that would be non-bank quality, what would be interesting to look at is those in the energy patch, meaning the refiners and the drillers, because you may see some bankruptcies in that sector.
Yes, that's correct. And we are, I will assure you, we are keeping a very keen eye on the credit markets, and any, as you may have seen, the Secretary of Treasury Mnuchin just yesterday talked about backing the bank loans for the energy sector, and they're talking about actually making it into, in effect, convertible into equity for the government, similar to what they did with the TARP funding in 08 and 09.
All right.
What's the break even on a domestic driller? It's about $32 a barrel, right? Is that about right?
I don't know the exact number, but that it's in that neighborhood.
Okay, thank you.
All right, if we could, we'll move forward then to in your
Yeah.
presentations. Good. So let's move forward to let's look at page 23. There's two things going on here. First of all, we were just talking about energy, and it's great your level of awareness of that factor, because we seem to talk to a lot of clients, and they're, the big focus is on COVID-19, and that is the largest factor that's impacting demand on a global basis. But we were probably going into a rough patch anyway, even without COVID-19, with the Saudi-Russian emphasis on damaging U.S. Oil production, and also looking to damage one another. So we had this. We're in a period of declining energy prices, and that certainly would have led to a reduction in GDP, probably not putting us into a recession. And then with the COVID-19, where we had this massive decline in demand, that has put us into a recession. That won't be official until we get through the second quarter and see the GDP numbers. But you've all been paying attention to what's been happening with unemployment claims, and you're all aware of just your own personal behavior, and that's happening not just in the United States but globally, as I mentioned. What's important for us as investors when we're talking about managing a pension plan is to keep in mind the long-term nature of these assets and the long-term liabilities that we need to fund. And as we discussed just the other day, a couple weeks ago, that the best way to invest for long-term liabilities is to have the best performing long-term assets in your portfolio, and make sure we've got adequate representation of that. And that was the justification for the increase in our equity targets, which have been implemented in the last couple of weeks. What page 23 shows you is there's a lot more blue on this page than orange. It might be an easy way to look at it. The blue graph represents periods of time where bull market, equity prices increasing. You can see that on average it lasts a little over 6.5 years, with a cumulative average return of over 300 percentage points. So very significant upside when we're in a bull market. Bear markets, while very painful, and with an average loss of about 36%, this is looking at the S&P 500 in both cases as a proxy for equities overall. They have a tendency to be much shorter lived. And you can see an average of 1.3 years. And so what we've been talking to clients about is we certainly recognize that it is different this time. COVID-19 is a different catalyst for the economic impact, economic decline that we're seeing. And it's in many cases more painful to everybody because of the impact it has on our daily lives and the changes that we've had to make in our culture, in our behavior. But from an investment standpoint, it's similar to what we've seen in the past, in that there's this a new catalyst that is introducing a change in economic behavior, reducing corporate earnings, and investor behavior is response to that, and we'll show you a little bit later on, there's great similarity from one market cycle to another. On pages
I have to
24
comment on this slide. I comment on this slide because I think this slide, guys, is as captivating and as brilliant a slide as you could put together for the average or non-savvy investor. It really is fantastic. I was commenting to Brian the other day about it. Folks that have a little bit of experience in the marketplace understand that this is the case, but this snapshot, say for the union, is very important. It is just a brilliant snapshot that it's time in the market, and your other slide, because you may not get to it in this amount of time, your other slide indicating the 40 largest daily gains in the last 20 years or so, I think it was, so critical. Those two slides are so critical for the average investor to understand that it really is time in and investing in good companies. If you do those two things over time, you will make money. So these are very good slides. I want to thank you for these slides.
Well, thank you for that. And you hit the nail on the head. It's all about investment discipline. It's making sure that you have the appropriate asset allocation, which we now do for the pension plans. And then it's having the discipline to stay with that asset allocation, which means when the markets are dropping and there's fear in other people's eyes and they're running for the hills and they're selling because they see other people being fearful, that's the time when it's most important to be stepping up and buying equities to make sure that you do have you meet your allocation targets. And that's what we did for you a couple times in March. And should we, we don't know if we're at the market bottom, if we've seen it or not, but we certainly may not be. The consensus thinking, by the way, is that there isn't going to be another drop. That the consensus thinking is, I can assure you, is not always right. But in any case, should that happen, we'll be doing, this chart is a good reinforcement as to why it's important for us to rebalance again. Pages 24 and 25, we're certainly not going to go through all of these data points, but on page 24, we're looking at equity or equity surrogate returns. We threw in the far right-hand column oil because of what we eat. Over the long haul, we recognize that lower oil and lower energy prices can have a favorable impact on economic activity. But in the short run, when you have a major industry that is going through this incredible contraction in a compressed period of time, it's deflationary. And so we have two deflationary things happening. We have one that's very industry specific, one that's more macro with the COVID-19 and the drop of demand, the layoffs that are taking place, etc. And that was very quickly reflected in the capital markets in a very severe, painful way, as shown on page 24. On page 25, the question earlier about exposure to lower quality bonds, you can see that the higher investment quality holdings did do very well, and it generated positive returns. And poorer or lower credit quality investments have gotten hit hard. Emerging market bonds, we have no exposure to that, thankfully. High yield bonds, we have minimal exposure to that. As I mentioned earlier, there's a tiny amount in that Barclays aggregate broad bond market holding that we have. No exposure to bank loans and preferred stocks, which have been used by many investors as a bond surrogate, thinking that it was a safe place to be. Dealt a lot with that over the last year and a half to 2 years, telling people that that's not a safe place to be. You can see how poorly they have performed. So the phrase that we use at Alesco is make sure you know what you own and make sure you know why you own it. We try to do that across the board of all of our holdings. Everything we have in the portfolio has a reason to be in there. On page 26, this is the $64,000 question. Where do we go from here? We show the consensus thinking for the GDP decline in the second quarter is 20%. To put that in perspective, in the worst quarter in the 08-09 crisis was negative 8.4%. So we're looking at a very significant drop here. Not a surprise to anybody on the phone, I'm sure, but it's we're going to see some ugly data come out. So brace yourself for that. The good news is as you know, things are starting to open up again. And so we will see it. We will see a recovery. The question is, what is that recovery going to look like? We show three common scenarios. The thinking at this point is it's going to be very industry specific. Some industries are going to have a V-shaped recovery where things get back to normal very quickly in those industries. Profits are restored relatively quickly, etc. There are going to be industries at the other end of the spectrum, the L scenario, which is that they don't recover quickly. It takes a long time. You can think perhaps the travel and leisure industry would be a good example of that. It may surprise us, but I would guess that's going to be the case.
Jim?
But on an aggregate basis, on a cumulative basis, we're probably looking at something like that center scenario, that U scenario. Things do come back. It takes a few quarters to get back, and we also don't know the impact. There's some variables out there. Certainly, a second wave of the virus coming into play, and the offset to that would be having some success with the antivirals, getting a vaccine into the marketplace sooner rather than later, or having visibility as to when specifically the vaccine is going to be available. That's going to have a big impact on demand.
Jim?
Yes.
Any thoughts to a W-shaped recovery due to a second outbreak or prolonged business shutdown and poor earnings going on for 2 or 3 quarters?
Yeah, so I think we think 2 or 3 quarters is very likely that we're going to have a slowdown. When we go beyond that, the idea of recovering and then dropping, what we think would be the most likely reason for that would be not finding they're not being able to create or be able to produce a vaccine that in high enough levels of production to meet the demand. That would probably be the big scary thing that could unfold that could lead to another big drop. But there's just no, if you think about what we're doing in managing the portfolio, we just can't predict these things. And so what we think what's the most important thing for all of us on the phone today is think about the next 10 years rather than the next 10 months. And that if we think about the next 10 years, we can say with a high degree of confidence that the stock market's likely to be considerably higher. In 10 years from now than it is today, the profile of how we get from where we are today to where we are 10 years from now is anyone's guess. And we think that we can do more harm to the plan participants and to the future beneficiaries, future participants of the plan by not sticking to the investment targets.
Okay, thanks.
So on page 27, the takeaway here is that the manufacturing sector has really, even though it was not doing as well going into this downturn, has held up far better than the service sector. The service sector has been inordinately hit in just a few areas in entertainment and leisure. We show services as well. That services sector is primarily our businesses that support the entertainment, leisure, and travel industries. So there's just, some parts of the economy are being just decimated. Others are moving along. And as you know, there are some businesses that are really doing quite well. Page 28, we're not going to go through this in detail, but the CARES Act is really, we're very, very pleased with how our politicians in Washington got back on the same page after being very divisive for so long, and came up with really a very good program. As we had seen, it wasn't large enough, so there's another roughly $500 billion approved yesterday, likely to be signed into law today by the president. Focusing, the next $500 billion is focusing again on small businesses, but also hospitals, and I think higher ed is part of that as well. But anyway, these types of stimulative packages will prove to be very effective in terms of getting us through this downturn and is mitigating as much as possible the demand side of things, the decline in demand. And then the Fed on page 29 stepped up as they need to. Those of you that are historians and have paid attention to past downturns and panics in the markets, both fixed income and equity markets, what stems the tide is this recognition that there's a lender of last resort. That phrase is very important. And just as Ben Bernanke did in 2009, and it's probably helpful that 2009 was not that long ago, we had the Federal Reserve step up again and say that we're going to protect the banks, we're going to keep liquidity flowing, and they've done a very, very fine job of that. History will look back and they'll poke holes that, this could have been done and that could have been done. But given the time constraints and how quickly all of this has unfolded, federal government has done a great job. You can see what's interesting right now that the EU, where they're struggling to get some decisions made that hasn't been coordinated, and they're going to have a much, I would guess, they're going to have a much deeper recession than we are, and probably also longer lasting. Just on page 30, we talked about energy a minute ago. The Saudis and Russians were looking to hurt one another and also hurt U.S. producers, and they've done a good job of that. They both Saudis and Russians are reeling right now, and of course our energy system is also hurt. You saw what happened with the May futures oil delivery, the delivery of oil for May, how that actually went negative to the tune of close to $40 a barrel. There was a crazy day, but the takeaway from that is this is an industry that really has taken it in the broadside here, and it's going to take some time to recover. I'm going to finish up in the next two slides here, and then I have to hop off, and if you have questions, Tim will be able to handle them. But just page 31, I won't get into any detail here. But it's something that is just important to remember, that the markets are moved in the short run by emotions. And this shows you the cycle of emotions that we go through with the stock market and to a lesser degree the bond market. But where are we on this curve right now? I think it varies by individual. A lot of people are still very fearful and even panicky. My read on most of our clients is that we're kind of bottoming out here, and people are hoping that we get some relief and start to feel better. So we'll see how that plays out. But again, it's important to see the animal instincts here and recognize them as such, that when other people are panicking, it's important to keep our heads and stick with the investment discipline. And then on page 32, the bottom slide here just shows how important it is to stay invested through a market downturn, because when the markets do ultimately bottom out, a huge percentage of the bull market recovery takes place in a relatively short period of time after the market bottoms. So I will leave you at this point. If there are questions, Tim will be able to stay on. It's good to speak with you, and look forward to seeing you hopefully in the not too distant future. Bye-bye.
Thanks, Jim. Tim, could you just comment quickly on...
No, sure, go ahead.
Just comment quickly on the how in some areas you're using, it appears to be like index or passive ETFs, and others are actively managed mutual funds, and why the difference?
Yep, so if we look at, I'm going to slide up to, why don't we look at one of the pages real quick on the review. Just go up to the top, and you can look at page 6 maybe. Any of the portfolio appraisals would give you that, and I'll just refer to page 6 and 7 just to show you. The vast majority of the portfolio is in index-based market tracking funds. All the ETFs are like that. They're not actively managed in any way. They track an index, the S&P 500 or the MSCI EPA index, for example, for the first two that are listed, the two largest equity holdings. A couple of the funds are slightly different. They're index-like, but maybe we could describe them as quasi-index. One of those would be the DFA U.S. Large Cap Value Fund, DFLVX. That's a quasi-index fund. We use it because we believe it's the best vehicle to capture value exposure in the market based on how DFA manages those funds. They use the Russell 1000 value as their starting point. Then they apply a few screens, price to book type screens to the portfolio to reach what they want. Then it's managed very much in an index fund. So there's a little bit of an active overlay there, but then they manage it like an index fund, low turnover, and keeping it very consistent from that perspective. Another fund that is potentially a little bit of a orientated is in the from a value perspective. So the DFA funds are like that in terms of how we manage it. The fixed income funds on page 7, all of those are index-based investments. So we really don't have anything other than the DFA funds that aren't index-based. The Bridgeway fund is a little bit of a quasi-index, but there are no actively managed funds within the plan. Is that helpful?
Yep, thank you.
I just wanted to follow up. When Jim was talking, I was able to pull up, I didn't have the actual number at the top of my head, but the below investment grade bond exposure in the Vanguard Total Bond Fund is 5%. So it's a very, very small portion of it, and the vast majority of those bonds are in BB. So that's just one step below investment grade. So the exposure to that risky area of the bond market that Jim actually highlighted is very low within that fund. So I think you can have some comfort in that from a risk perspective within those bond funds.
Is there any cash in
I know we want to.
Is there any cash in the portfolio, or are you considering the Federated Fund to be your cash?
The cash in the portfolio, we actually did raise that. If you look on, we would stay on that page for essentially non-salary, page 6. The cash is in the Federated Fund. So there's about 4%, 1.3 million in that. And that's a little bit higher than we normally would hold from a cash perspective. But each one of the plans has about that much cash in it currently. And that cash was increased coming out of the bond side of the portfolio, not the stock side.
Okay.
And just one other thing, I know we've kind of gone over our time here, but I just wanted to make sure everyone had a chance to look at that second set of 3 pages handouts that we provided that are the update. We felt since we had met with you earlier in the year and revised the policy and increased the allocation, we wanted to show you where that was. And we started implementing that at the beginning of April, maybe April 8th. So that second handout that I have, I won't go through all 3 of them because they're the same way, but it just gives you a sense of the current allocation to the portfolio and how it was divided up. And then at our next review, we'll break out each one of these holdings. But the equity and the fixed income isn't changed from a holdings perspective. We've just added a few additional assets in that real return category, real estate investment trust, commodities, and inflation protected securities. And we'll highlight those at our next review meeting with you. But the breakout box on the right-hand side shows you the market appreciation in the portfolio since April 1st. So the market, or the portfolio, I should say, has gone up about 5.5%. That's through last Friday, and this week it's been a good week too, so we're up a little bit more than that. And then the percentage of the returns below are for all the various asset classes during that roughly 17-day period. So the markets have recovered quite a bit during this time frame, and that was coinciding with us increasing the equity allocation of the portfolio.
All right, Tim, thank you very much. Mr. Suslich, I'll turn it back over to you.
Is there any other questions from the other board members?
I'm on board, Bob and Brian, just to let you know.
Perfect timing. So that would conclude the Pension Committee meeting. And at this time, I'll turn it over to Nick.